Welcome to the session EPS Part 7. Look at the problem first. This problem has given in the year May 2013 for section C. Forms X and Y are identical except that the form X is not levered while form Y is levered. There are two firms are there. One is X and Y. These two companies are similar in nature. But there is only one difference is there. What is the difference? X is not levered and firm Y is levered. Levered means a company that funds its operation by taking loans or borrowed capital. Not levered means this company or this firm has not taken any loans or this X firm has not issued debentures, but Y firm has issued debentures. Okay, the following data relate to them. There are two firms are given X and Y. Assets 5 lakh and 5 lakh. Debt capital, as I told, firm X is not levered means they have not issued any debentures, so it is 0. Firm Y has issued debentures, that is the debt capital 2,50,000, 9% interest is there. Then equity share capital for firm X 5 lakh is there and for firm Y 2,50,000 is there. What is the total capital for firm X is 5 lakh. Firm Y, what is the total capital? 5 lakh. So it is here in the first line itself they have given firm X and Y are identical. Means the total capital, total assets of the firm is same. That is assets is 5 lakhs and total capital is also 5 lakhs. But in firm X, they have issued only equity share capital, that is 5 lakhs is there. But for the firm Y, there are two types of capital is there. One is debt capital 2,50,000 and equity share capital 2,50,000. Number of shares for firm X 50,000 and for firm Y 25,000. Rate of return on asset is 20%. It is same for both the firms. Why it is useful for the purpose of calculating EBIT. Next, calculate EPS for both the firms. So we need to calculate the EPS for firm X and for Y. Assuming tax rate 50%. Will it be advantageous to firm Y to raise the level of debt to 75%? See here, as I told, the total capital of the firm Y is 5 lakh. In that 5 lakhs, 2,50,000 is debenture and 2,50,000 is the equity share capital. Means 50% debt capital and 50% equity share capital. We have to calculate first what is the EPS for the given information or existing situation. Second one, what we have to calculate, again we have to calculate the EPS when debt capital increased to 75%. So here only 50% is there. Again we need to calculate EPS when debentures is 75% and remaining is 25%. We have to take it as equity share capital. Okay, first look at the solution for the first one, that is for the existing situation or for given information. We are going to calculate the EPS first. Okay, calculation of EPS under existing situation or given information. For both the companies at a time we are going to calculate the EPS, that is firm X and firm Y. Number of equity shares, it is given in the problem C. Number of equity shares 50,000 and 25,000 that I have entered here. Next, Earnings before interest and tax, that is the EBIT, we need to calculate. So, what is the EBIT information that is given? See, a rate of return on asset 20%. On assets, we have to calculate the 20%. What is the assets amount? 5 lakh. It is same for X and also for Y. 5 lakh into 20%, 1 lakh will come. So, this is the EBIT for firm X and also for firm Y. Then, less interest. So, for firm X, there is no debt capital. So, here it is nil. But for Y, there is a debt capital of rupees 2 lakh 50,000 and the rate of interest is 9%. 2 lakh 50,000 into 9% means 22,500. Now, EBT. How we will get the EBT? We have to deduct the interest from the EBIT. Here for X there is no interest, 1 lakh as it is, it will be there. Next for firm Y, EBIT is 1 lakh and interest is 22,500. Then EBT is 77,500. Less tax. The tax rate is given, that is 50%. Tax rate at 50% we have to deduct from the EBT. That is 50,000 and 38,750 for firm X and Y. After deducting tax from the EBT, we will get EAT for firm X 50,000 and for firm Y 38,750. Next, less preference dividend. In the problem C, there is no preference share capital. So, preference dividend is not there. Means it is nil. At the end, we will get net profit available to equity shareholders. That is 50,000 and 38,750. Then EPS. The formula for EPS is net profit available to equity shareholders divided by number of equity shares. Net profit is 50,000, number of equity shares is 50,000. EPS is rupee 1 per share. And for firm Y, net profit is 38,750 and number of equity shares is 25,000. EPS is rupee 1.55 per share. Okay. So first thing we have calculated, that is calculation of EPS under existing situation or for given information. Then second one, we have to calculate what is the second one? Will it be advantageous to firm Y to raise the level of debt to 75%? That we are going to calculate it now. Calculation of EPS when the firm Y raises the level of debt to 75%. First, we are going to calculate the capital structure of firm Y because the information, that is what they have given, will it be advantageous to firm Y to raise the level of debt to 75%, and there is no change for the firm X, only there is a change in the firm Y. Okay, so we are calculating capital structure of firm Y. What is the asset of the firm Y, or we can take what is the total capital. Total capital of firm Y. Total capital of firm Y. Okay, what is the total assets or total capital is rupees 5 lakh. Okay, now less debt capital. What is the debt capital? Now they are telling it has increased to 75%. Okay, total capital is 5 lakh into 75%. 3 lakh 75,000 will come. The remaining capital is equity share capital. Means debt capital. If debt capital or the debentures is 75% means the remaining is 25%. That is the equity share capital. 5 lakh minus 3 lakh 75,000. 1 lakh 75,000 is the equity share capital. That is 25% of capital. Now we are going to calculate the EPS now. Now see here, number of equity shares first we need to write. There is no change for the firm X. There is no change or there is no difference for the firm X because there is no debt capital, only equity share capital. Whatever given the information in the problem, same information. Already we have calculated in the previous slide, but same thing I have written here for firm X. Okay. Number of equity shares 50,000 for firm X, but for firm Y, how much? See, equity share capital, how much it is there? 1,75,000. It is the capital. Or what we can take, number of shares is here 25,000. On this 25,000 shares, 25% how much? 12,500 will come. Or you can calculate the face value of the equity shares, then you can take the 25%. Here it is easy, you can go like this only, that is number of shares is 25,000 into 25%, 12,500. Then EBIT, that is what is the total capital? 5 lakhs into 20%, 1 lakh. It will be same for X and Y. Then less interest. For firm Y, it is not levered. It has not issued any debentures. But for Y, the debt capital here we have calculated 5 lakh into 75% is 3 lakh 75,000. Okay. 3 lakh 75,000 into rate of interest will be same. That is 9%. Interest amount is 33,750. Then we will get the EBT for firm Y 66,250. Then we have to deduct the tax at the rate of 50%. Then we will get EAT less preference dividend. There is no preference share capital, so there is no preference dividend. At the end we are getting net profit available to equity shareholders, that is for firm X 50,000 and for firm Y 33,125. Next, we need to calculate the EPS. The formula for EPS is net profit available to equity shareholders divided by number of equity shares. That is for firm X 50,000 divided by 50,000 means rupee 1 per share will be EPS. And for the firm Y, profit is 33,125 and number of equity shares is 12,500 and EPS is rupee 2.65 per share. What is the conclusion we have to write? Because they have asked us, will it be advantageous? So, we have to say whether it is advantageous to firm Y if they rise the level of debt to 75%. So, that is what I have written here, inference. Yes, it will be advantageous to firm Y. So they have asked us whether it is advantageous. Yes, it will be advantageous to firm Y. Why it is advantageous to the firm Y? Because since it increases EPS from 1.55 per share, that is for the existing situation, that is 50% debt capital was there and 50% equity share capital was there. At that time, EPS was 1.55 per share was there. But if they want to increase debt to 75% means EPS will increase to 2.65 per share. Okay, it will be advantageous to firm. Why? If they have to increase the level of debt to 75%. Thank you.